unlike a hurricane or an earthquake, where there may be a market or a geography that's hit, this is the whole country, and so the scale is totally different. What's been done thus far is substantial, and my team is continuing to keep an eye out to see if there are areas or pockets where relief is not getting to. We've heard a lot of concerns about the size of the support. What does that mean, the existence of this support mean for people being willing to get back into the labor market? I'm in the Southeast. There's a lower cost market, and there are a lot of jobs for which the support appears to be greater than what the market rates are for wages. We know that about 40 to 45% of families don't really have any kind of savings, right? And so they didn't have a buffer to fall back on. So if they don't have income, they're really not going to be able to spend on anything. And so this is a really big change for that. All the facilities that we've put out have been in response to signs that particular markets were breaking down. If we have all corporations not being able to issue debt to raise capital, that then is going to put stress on their lines of credit, which then puts stress on banks. We provided extra liquidity for the Paycheck Protection Program. We're working on the Main Street Lending Facility, which is really designed to reach out and touch businesses above that SBA limit of 500 employees or less. We're trying to make sure that there's support and relief that gets to virtually all segments of the marketplace. Through the CARES Act, there's a lot of forbearance that was put out there, that was offered to families, and that has direct implications on the basic functioning of the mortgage market. The Federal Reserve continues to buy a significant number of securities to try to make sure there's liquidity in the market. We were starting to see evidence that mortgage lenders were pulling back from certain types of markets. There was a risk that this was going to bleed into the single-family purchase market. We've seen a lot of reduction in tension in that, and I think that's a very good thing. The day before the virus came here, the economy had been growing for basically 11 years. The whole idea, in my mind, to the policies of relief that have come have really been to try to preserve as many of those fundamentals as possible, so that when we get to the other side of this, those fundamentals can click back on. So we're monitoring right now to see to what extent this relief is providing those sorts of bridges and preserving that stability. It's just important to remember the PPP money is relatively new to the economy. There's still a lot of relief to go through, and we're going to start to see, I think in the next 3 to 4 weeks, get a much better picture of what that's meant in terms of preserving stability. We at the Federal Reserve have really encouraged banking institutions to work with their borrowers and their customers. I've actually not found anyone who has said, I'm just going to hold everyone exactly to their terms. I'm actually not that worried about inflation now. The oil situation remains significant. The introduction of technology is reducing the cost of doing a lot of business. We definitely make sure that our central banking partners around the world know sort of how we're thinking about things, know the issues and the concerns that we're seeing. We want to make sure that the global economy gets through this, because we are part of that economy. We need to make sure that businesses stay as stable as possible. We need to make sure that households are able to continue to bridge this, and also that people stay healthy. This is a public health crisis at its heart. And because of that, the recovery is going to really depend on how well we do in dealing with that crisis.